Welcome to the AI Agents Meet Blockchain. Man, we have an amazing future. We got a lot of data to go over. We're going to get you ready for 2026 by going over what has happened in the DeFi space, digital finance, up until 2025. Now, what are we going to go over today? We got a couple things. I want you guys to sit back, relax, maybe get a pen, notepad, or just listen and see how this aligns with currently what you're doing right now. We're going to go over some summary. We have the intelligence infrastructure revolution, the rise of autonomous financial agents, infrastructure and market dynamics, market data and investment flows, institutional adoption and future outlook, regulatory and technical challenges, and some key takeaways for you to take away. Now, the executive summary. What's happening? We're seeing a shift. We're seeing this shift from experimental integration to more practical deployment. The current state up until December of 2025, there's about 10,000 AI agents earning roughly about a couple million a week. That sounds crazy. I know. Imagine an AI doing all the work for you. There's a projection that we'll see an increase of more AI agents by year end. And what are we seeing right now to align with that? Anthropic making a new data center and merging with Hut 8. You see NVIDIA coming out with new CPUs, right? New GPUs. You're seeing an AI specific hardware. So they're already preparing the infrastructure and the hardware necessary for these projections that we at W3MCT research team have looked into. Now, the current market cap surged from 23 billion in 2024 to now about 50 billion as of February 2025. Decentralized exchanges volume forecasts. We're seeing that more and more participation coming into that network and going on to the blockchain. We're looking at a total decentralized exchange volume increasing to about 4 trillion. So let's go over the intelligent infrastructure revolution. We have the problem and solution. Seems simple. Well, let's get into it. The problem, centralization. Oh man. So if this AI native revenue, and I say that with quotes, we're talking about enterprise level LLMs, API usage, and spend. Now, the best current public data set that I can point to from December 9th, right, at Menlo Ventures, they report Anthropic about 40%, OpenAI 27%, Google 21% of enterprise LLM API usage. Top three equaling 88%. OpenAI and Anthropic combined, all right, is just 67%. So having the revenue and OpenAI and Anthropic really controls 88% of the AI native revenue, as you can see. And Menlo estimates this, about 37 billion in enterprise generative AI spend in 2025, with about 12.5 billion of that in foundation model APIs. Now, one thing we can talk about is cloud infrastructure. And what does that mean? So, right, we're talking about cloud having a 63% of the infrastructure owned by Amazon, Microsoft, and Google. Is that accurate? Well, let's find out. I mean, think about this. AWS, Microsoft, and Google, they have about 63% of enterprise cloud infrastructure spend noted in Q3 of 2025. So these still highly concentrated, and these services are controlled by the top dogs. Now, when we get into hardware, we were talking about hardware devices, right? And the new CPUs and GPUs and new computers that NVIDIA has been working on. And this 94% figure is right on point. I mean, we're talking about, discrete PC add-in board GPU shipments, not strictly just data center GPU market share. But John Pettin research reporting, right, shows NVIDIA 94% of this discrete desktop GPU shipments just in Q2 of 2025. Now, for the AI accelerators and data centers, right, many analysts cite very high dominance, and we think that this exact percentage will vary And it depends on the GPU, accelerator, units versus revenue, hyperscaler, internal, ASICs, right? Region restrictions. There's a lot that goes into this percentage. But at the same time, a range of about 80% or more for all of this, with forecasts expecting competition to increase over time. And so NVIDIA has got a huge supply choke point, and it's got a chokehold over the market. And I don't see NVIDIA doing too much more after that. So what is that a problem? I don't know. To some, it may be a problem. And to some, the solution may say, hey, we need to start thinking about why AI agents need machine trust. See, agents aren't just users with wallets. They are autonomous actors making commitments. Those commitments are known as payments, swaps, collateralization, access rights. These AI agents are operating across unknown counterparties and under adversarial conditions, right? They're doing MEV, spoofing, identity forging, fake state, and some other things. So what do they need? Code is law and verifiable. So we need some deterministic rules. We also need to know who owns what and after what conditions, right? So that is the settlement, the objective settlement. We need agents that can safely call another agent's contract, known as composability. And simple, no single gatekeeper. No single gatekeeper should be able to block transactions. Censorship resistance. That is what machine trust and trust minimized coordination. That's what this is all about. And so you may say, which network will be able to do that? Ethereum. Ethereum has this trustless coordination layer for agents. And at the same time, with a global state machine, agents can rely on. They expose a shared state and a message passing system. Accounts send transactions that update global state. Every node independently verifies those executions, right? The gas fees, the gas exists to meter the computation and to prevent abuse and DOS, denial of service. Fees are part of the security model on Ethereum. Now, the implication for agents, well, they can coordinate with anyone using the same rules without bilateral trust. Now, smart contracts. You hear Ethereum, you hear about smart contracts, and those are permissionless programs. Smart contract. Anyone can deploy and interact with contracts. Trustless usage is improved when contracts are verifiable. And so when it comes to these agents, contracts become neutral. They're escrow plus logic, right? And these rails for deals between algorithms. And that is how they're going to do that. Now, when it comes to the settlement and the finality, there are some realistic latencies expectations, right? Ethereum layer 1 is not millisecond speed. It's high integrity settlement. So it's supposed to be a little bit slower, and that layer 1 really uses, all right, you know what? It is a high integrity settlement. It does take some time. It may cost a lot in gas fees to transact on the Ethereum blockchain. However, this is the direction that Ethereum is going. And with the institutional adoption, high integrity settlement is going to be extremely important. So consensus uses Gasper, right? And we're not going to get into all of that, but finality is typically measured in minutes, not seconds. So best case confirmations can be 13 and 19 minutes, depending on when you land on the epoch. Now, for AI agents, the implication to this is, well, the layer 1 for high value settlements, and then using layer 2s for the high frequency actions. So layer 2s, what are those? Machine speed. These layer 2s are supposed to be anchored by Ethereum Trust because it uses the Ethereum virtual machine, the EVM. And so when it comes to this explicit, roadmap for Ethereum, what does scaling look like for them, right? And so they added some new EIPs and they added some blob transactions so these rollups can post data cheaper than call data. And it will help improve some of the L2 layer 2's economics. Now, how well will the market receive this and actually utilize this, we need to see the increase of activity, of on-chain activity when it comes to Ethereum. However, but it looks like their future and forward thinking, and they foresee the blockchain and the Ethereum network going through a high volume of transactions, and with institutionals trying to come over to Ethereum to use that network, it's going to be a combination of using the both layer 1 and layer 2 for it. But as of right now, we're not seeing that on the chain activity. It is quite low when it comes to Ethereum. However, that doesn't mean the technology, the infrastructure, and foundation of this new technology is not able to handle it, right? So that's the good part. And when it comes to understanding how these agents are going to interact, right, with the account abstraction. So agents will need session keys, suspended limits, batching, fee sponsorship, and programmable authorization. And so with Ethereum's account abstraction direction, it will allow the on-chain entry point. No protocol changes are going to be required. You can see the ERC documentation for this. And the Ethereum's transaction docs also reference newer transaction types designed to be forward compatible with account abstraction. So we'll see about this, but when these AI agents, right, should be able to operate safely with least privileged keys and sponsor paymaster flows. That is something we're going to look more into when it goes, for the decentralized fintech future, right, of machine trust. And so when it comes to this rise of autonomous agents, we went over a lot in that last slide about AI agents and how they're going to be able to communicate on the blockchain and what are some of the requirements utilizing Ethereum to do so. So let's kind of dive into that just a little bit more, and let's get a good understanding to what these autonomous agents really can do. And so the agents will move beyond DeFi. They'll move into social, and they'll move into gaming. So the early agent adoption clustered around decentralized finance execution. So we're talking about trading, staking, liquidity, but the bigger shift is that agents are now winning distribution where humans already spend time. We're seeing AI agents on social feeds, right? We're seeing AI agents pertaining to gaming or playing some games. And Van Eck explicitly predicted this transition, surprisingly. Agents as influencers, game players, and interactive companions, not just financial bots. And so what changed technically, and why is this happening now? Well, agents can now run continuously, right? They can produce content, respond to users, and monetize attention. Tips, tokenized communities, gated access, all run by an AI agent. We have social native agent frameworks now ready, shipped with embedded wallets plus incentives, making it easier for audience to co-own or fund agents. Virtuals is a common reference point in this category, but this is what's going to allow the future of blockchain technology and the decentralized ecosystem of Web3. Social influence at scale. We're seeing some of these AI agent bots on Twitter, now X, Twitter. And what is this telling us, right? Agent, niche, high frequency insights, audience, monetization paths to sponsorships, gated alpha, tokenized communities. We're seeing some of these AI agents, scale to over 500,000 followers on X and some even more. And we're also seeing a lot of these AI agents being replicated and doing meme content, right? So there's so much that is going to happen from now and the coming years within the next decade, half decade, right? And maybe even faster than some of us are even thinking ourselves. And so when it comes to revenue and it comes to understanding some of these new ways of interacting online with AI agents, not only from the agent perspective, right, the operator or the creator, but also from the consumer's perspective of how to even interact with these AI agents and use the data or the information to the best of their own ability. We'll see more in the future, and we're going to be looking into how the market cap related to AI agents will increase And some of these new technology trends, if they will continue to stick around, we're seeing a small growth when it comes to AI agents and, now hyper focus on task oriented. And we're going to see what revenue will look like for all of this, right? For usage, for activity, for scaling, financials, right? Top agent influencers we went over. So these are just all low level at the beginning of this technology being used right now, somewhat successfully. And as more and more people start to see the blueprint of this, we're going to see more of an increase in volume when it comes to AI agents and getting them deployed really by many different kinds of individuals. And so for all of that, right, we need infrastructure and security because that's still really important. Infrastructure and security is really the foundation when it comes to high quality, intel and data. You can say investments, knowledge, not financial advice, but for anything to be built, right? For a home to be built, you must build and you must do the foundation. You must do the infrastructure. You must have the things in place, security of your equipment, right? All of these things matter for anything to really be built on a network, right? Where more and more people will be able to use it. And so some of the things that we found about when it comes to Telegram and the Telegram's infrastructure, and they're using this TON integrated network that lets GPU owners earn the TON token by serving AI inference workloads. So what does this work, right? How does this work? GPU owners will run on the Cocoon stack and they will get TON payments, ton payments per processed request. So what does this design aim to do, right? It's for private attested model execution, confidential compute. Clients can rely on attestation and defined trust model so prompts and outputs aren't exposed to the node operator. I don't know why I was having trouble with that word right there. But Telegram has published Cocoon's code and docs publicly, suggesting the intent is to make a decentralized inference a real developer primitive, not just a marketing line. So why does this matter for agent infrastructure? Well, agents will need a cheap, always on inference. Cocoon is one of the clearest examples of pay GPUs. So it's like a DPIN style rather than renting from centralized hyperscalers while emphasizing confidentiality. So what is a security gap? Well, according to Anthropic, they introduced the Scone bench, right? And a benchmark of 405 smart contracts. And what does this all really mean? This is about the exploitation of contracts from 2020 to 2025 across Ethereum, Smart Chain, and Base. And in the simulation, right, we want you to know that, wow, it's a lot more than I thought, right? Successfully exploited 13 of 20, so roughly about 65%. And a simulation of essentially you can do, say, 3.7 million in stolen funds. So what does this mean? They're saying that between the AIs that are available right now to control for training data contamination, they evaluated models on vulnerabilities exploited after model knowledge cutoffs. And so some of these problems, 55.8% of the post cutoff portion, roughly about 4.6 million of simulated stolen funds. So the contracts tested versus the contracts exploited. And we need to know this because this is important for security. We need to, and as more AI agents are coming about, right, and more intelligence available to anyone, essentially, right? Any smart contract on the blockchain will have to be audited by third parties, have a security auditor, and that's continually testing the quality and any of the vulnerabilities of that contract, right? Because when we have AI agents that are doing transactions for us in the future, funds stolen by another AI, it's gonna be, that's a huge vulnerability, and so out of the contracts tested of 30 were exploited, right? And given Anthropic Red a 55.8% success rate. Now, these are critical insights. Instead of, it's a tough thing to swallow, right? Because the tested agents, again, recently deployed contracts with no known vulnerabilities found 2 novel 0 days, smaller dollar value amount. And this is all a simulation, but that doesn't mean this is not something we should prepare for. So the reality check, Ethereum best practice, right? Treat smart contracts like production finance software. You need access control, invariance, guardrails, test rigor, independent review. You need to follow core solidity security patterns, right? To reduce reentrancy and control flow risk. And assume attackers can automate. So keep the contract simple, minimize privileged paths, and design for safe failure plus recovery. And this is coming straight from Ethereum and the Ethereum dev team. And so, yeah, we went through some of the tough stuff in the beginning. I know it was a lot to process, and that was a lot of information. Now let's go to the fun part, right? If you make it through the trenches and you are a forward-thinking type individual or person or business, right? There is an upside, and let's go over the market data and some of these investment flows. Again, this is educational content and informational purposes only. This is not financial advice. Anything discussed here related to this is not an indication to buy, sell, or interact. Anything should be done for you. Please contact a professional financial advisor. All right. And so let's get into this part here. We're showing 3 signals of where capital is flowing in Web3 right now. We're seeing capital flow into trade and liquidity, stablecoin payments and remittances, and AI agent sector valuation. So we're going to think of this as the market's vitals monitor, okay? And so the first one, trade and surge, 10 trillion in October of 2025, which that would include spot and derivatives. So first, liquidity was back. Well, in October 2025, it was. Centralized exchanges saw a combined spot plus derivatives volume hit about 10.3 trillion, which was a 25.9% jump month over month. That's a major risk on signal. It tells us speculation is elevated. Hedging demand is elevated, and the market is deep enough for institutions to rotate size again. And as you are aware right now, the current Bitcoin price is, I believe, around 88,000. I can go ahead and pull this up. And so since October until now, right, we've seen Bitcoin come down. And well, now we're at 88,000, trying to retest the 90,000 level probably in the coming hours or so. So my point is that when this came out and we saw liquidity really hit that volume, right, 10.3 trillion, 25.9% jump in month over month, well, that was essentially the local peak. And since then, we've seen a nice retracement, and we've been in a bear trend for Bitcoin related trading. I'm not saying this is just, this is a combined, right? And it's not just about Bitcoin, but speaking on Bitcoin, right, it really lines up to the volume hit and then the cool down, right? So when you see derivatives expand alongside spot, it usually means the market isn't just buying, it's also levering, hedging, and taking structured exposure. And making this recording right now, we are in December 18th of 2025, close of the year. We're making this ahead of time to get you prepared for 2026 and what to look forward, so you can have the forward-thinking analysis from the W3MCT research team. We spent a lot of time collecting and setting this up for you, so I really hope you enjoy it. Now, let's get on to the next one, stablecoins, right? So stablecoins correcting the 19.4 billion payment volume year-to-date stat. So, yeah, let's one quick correction here. 19.4 billion is widely repeated online, but does not show up as reliable stablecoin payment volume year-to-date metric in primary data sets. See, for payments, the stronger current signal is that stablecoins are processing very large real-world payment flows, not just trade and settlement. So, for payments specifically, stablecoins processed about 9 trillion in payments in 2025. According to widely circulated summary, it shows, right? And on the enterprise side, research highlights that business to business stablecoin payments grew to over 3 billion per month by 2025. That's roughly 30x from early of 2023. The key takeaway isn't that one vanity number. It's that stablecoins have crossed into serious payment rail territory, especially in business to business and cross-border corridors. Chain analysis also frames stablecoins as a core medium for payments and remittances because of speed, fees, and accessibility. Now, remittances, US, Mexico, 5x to 400 million a month. What is this? So this is a forecast from to 5x to 400 million per month. This forecast comes from Van Eck's prediction that US Mexico stablecoin transfers would grow from 80 million to 400 million monthly as users adopt faster and cheaper rails. This was Van Eck from Brazil. Now, we also see some evidence that the corridor is already meaningful at scale. Bitso reports processing over 6 billion in US to Mexico remittances in 2024, which they describe as more than 10% of the total remittances volume between the two countries. This isn't theoretical anymore. So the 400 million a month is just a projection. The adoption story is already happening in production. So let's get into the AI token performance and let's see what's all of that about, right? AI tokens and AI agents. I'm treating them as of today metrics. And when it comes to AI token categories, that's roughly about a $5 billion market cap. All right, according to CoinGecko. And this AI agents category is about 3.8 billion market cap today. So older figures like 49 billion of total AI and 16 billion agents describes a prior peak cycle. It's not the current live market, right? And it also lets us know that it previously touched 16 billion at peak before retracing. Now the leaders list needs a quick update. For sure, because now Singularity Net plus Ocean Protocol are now commonly discussed in the context of the Artificial Superintelligence Alliance, ASI. This is rather than a standalone AGIX Ocean narratives forever. Superintelligence lets us know. The graph is still important infrastructure for Web3 data indexing, but it's not purely an AI token story. Think of it as enabling agent apps to query and react to on-chain state efficiently. So all of this, let's put it together. We have trade and liquidity is huge. Stablecoins are becoming real payment rails. Remittance corridors are scaling, and AI agent tokens are volatile but maturing into defined sectors. This is exactly what the next wave of winners will be: the teams that combine distribution, compliance, and real utility, not just hype. So how can you take advantage of the future? It's really, really simple. Get ahead and become part of W3MCT. Stay tuned, subscribe, like, and all you have to do is go to www.w3mct.com. We have a huge resource section, news, data, learns. It gets updated quickly, daily news article sites, and the W3MCT membership supported and collaborated with school is also available for you. Now, let's get back into this workshop. Institutional adoption. Oh, man. To some people, those are curse words. To others, it's a savior complex. Who knows? But institutional adoption is happening. And it's happening in 3 layers. Number 1, what Wall Street thinks is driving the next trading stack. But it's happening. Number 2, where infrastructure capital is likely to flow next. Number 3, why tokenization, RWAs, real world assets, are moving from pilots to real products. The Wall Street recognition, right? This donut chart here lets us know about JP Morgan's e-trading edit. This represents and shows the share of institutional trading respondents who named AI machine learning as the most influential technology for trading. Wow, most influential tech, 53%, up from 25% from the JP Morgan survey. Now, most current defensible data point, right? 61% of AI machine learning. Okay, that's from 2024 E-Trading, Traders Magazine. In 2023 edition, the AI machine learning was only 25%, with mobile trading apps at around 29%. So AI moved from important to dominant in just one cycle. JP Morgan's survey jumped from 25% calling AI machine learning the most influential tech in 2023 to now 61% in 2024. That's not a marginal change. That's a trading industry reprioritization. I don't know why the reprioritor. Wow, I'm losing to reprioritization. Trading industry prioritization. I'm gonna have to edit. That's not a marginal change. That's a trading industry reprioritization. And in 2025, commentary around the same survey series, AI and machine learning is still described as the top influence for the third year running, meaning the trend didn't fade after one headline year. When it comes to institutions saying AI machine learning is a top influence, they're talking about automating workflow, improving pricing, analytics, execution quality, and lowering information leakage. This becomes a structural advantage for the firms who implement it best. Now, what are strategic projections? Compute, blockchain GPUs, DePIN. Next is compute. Of course, the reason of decentralized GPU networks. They're taking it seriously, finally, right? Because there's a real market gap outside the hyperscalers. Think specialized GPU providers, enterprise demand spikes, and long provisioning times. VanEck, again, they projected, blockchain provided compute plus storage, and it could capture about 20% of the non-hyperscaler AI infrastructure market, producing roughly about $1.9 billion in revenue by 2030, which is their base case. And so this is not to say DePIN replaces AWS, but it's saying that there's a large non-hyperscaler segment where decentralized networks can win on cost, availability, and marketplace dynamics. Kind of like how Uber, but for now computers, right? Uber for compute. So you'll hear about RWAs. What is RWAs? Real world assets. Kind of like, real world assets, fake world assets. I don't really like the real world asset thing. I kind of like, we can say tangible assets, right? Or tangible digital assets, right? TDA, tangible digital assets, TDA. I think that would be much better, but whatever. So anyway, tokenization, market size, right? Let's get an update on this 50 billion by 2025 claim. So the tokenized real world assets, tangible digital assets, hit 50 billion by 2025. Well, today, the most reliable way to kind of say this about real world assets is that, it uses live market trackers and it defines what we're counting. Okay. But at the same time, the most current live metrics about this, we still have distributed asset value, tokenized RWAs outstanding about 18 billion, with stablecoin value about 300 billion and a represented asset value about 410 billion. And we put in represented in quotes. And so RWAs depend heavily on definitions. If you mean non-stable RWAs outstanding on chain, we're talking about closer to about 18 on this tracker today. Now, if you were to include tokenized cash equivalents, like especially stable coins, tokenized value, we're already hundreds of billions. So the institutional direction is definitely accelerating. And JP Morgan just launched a tokenized money market fund on the Ethereum seeded with 100 million, signaling that tokenization is moving from experiments to bank grade products. So the big picture, institutions now prioritize AI, machine learning for trading. Capital is hunting non-hyperscaler compute capacity, and tokenization is becoming a product category. With RWAs, TDAs, tangible digital assets, measurable in real time, and major banks deploying live vehicles. So all of that means we need to prepare for regulatory and maybe some regulatory challenges. This is a reality check. Every wave of innovation comes with risk. On the left side of the scale are the risks, which are misinformation, compliance pressure, and scaling limits. And on the right side are the solutions: cryptographic verification, better infrastructure, and smarter governance. So, the risk. What should we focus on? Oh man, this is gonna be, let's take a deep breath. Because we're going to have to worry about AI-generated fake news and fraudulent content, right? Trust is starting to collapse. And President Trump has been talking about this. He's been talking about it and he's been talking about it and he's trying, actually, I think he's doing quite well at preparing the people that pay attention that, hey, we really need to get ahead of the nefarious actors that are going to be using AI to trick people, to scam them, to take their stuff, and create, fraudulent content with this new technology. So one of the biggest blockers to this adoption is that people increasingly don't know what's real online. Between consensus plus YouGov, Web3 Crypto Global Survey, 76% of respondents said they're concerned about AI-generated fake news. That's not a niche fear. That's mainstream distrust. That's crazy. And we really need to start taking that more seriously. And that is why blockchain and Web3 is even more important. You have regulatory pressure rising because of this. And the AI Act is already in force and has staged obligations. Some rules began applying just in February of 2025. And they're saying general purpose AI model obligations start in August of 2025. Given full applicability on August 2nd, 2020, longer transitions for certain high-risk areas. In the US, we're seeing targeted laws too. I mean, just in New York, they passed a law requiring advertisers to disclose when ads use AI-generated avatar. The Take It Down Act, signed in April 29, 2020. This targets non-consensual intimate imagery and AI deepfakes, including takedown obligations for platforms. Now, has anyone in the room seen an AI clip this year that looked real at first glance? I'm sure many of you paying attention right now can go on Instagram or go on YouTube and see a clip and be like, wow, man, that looked real. That's what we're talking about. And so another risk, scalability bottlenecks for AI native activity. We're going to see AI workloads at a high frequency. And agents don't transact like humans. They transact like machines. So those machines to transact will require micropayments, rapid quoting, frequent updates, and lots of state reads and writes. That creates a throughput and cost problem if we try to put everything on a base chain. And so governance and accountability gaps. Risk number 3. Governance becomes harder when agents participate. If an agent votes, executes, or coordinates capital, we need accountability. Who authorized the agent? Under what policy was this agent allowed to do this? And can we audit what happened after the fact? Without good governance, we get automation of bad decisions. All right, we went through the problems, we went through the risk. Whew! Take a deep breath, right? Now, let's go into a different mindset and a different way of thinking. Let's focus on the solutions, right? Because now we know the challenges, now we know the problems, but we don't just leave you with problems at W3MCT. We provide solutions, solutions that you can implement, and solutions that you can rely on. And so the Web3 solution to these risks, right? Well, it's called truth verification. What blockchain can and can't do. Let's get into it. blockchains don't magically make information true. Okay? So let's just repeat that. Blockchains don't magically make information true, but they can make records tamper evident, provable. Who signed something, when it was published, and whether it was altered. In that same survey, 60% of the people who were concerned about AI fake news said they think blockchain could help mitigate the risk. Now, blockchain is a verification layer. It's great for provenance, right? Timestamps, signatures, content registries, identity attestations. The content might still be false though, but we can prove where it came from and whether it was tampered with. And so that will help create, because once it's on a blockchain, and if you can prove where it came from and whether it was tampered, and even though it still may be false, we can still then create agents to track all the false and tampered with content, right? But for us to handle and provide a solution of AI fake news, we need things on the blockchain, and we need to establish that. And so having everything on a blockchain, that means we're going to need the cross-chain interoperability, right? We're going to need the entire ecosystem of Web to really be focus on this. And at least when it comes to Ethereum, that's what they were focused on when it came to layer 2s, right? The L2s and data availability upgrades. So to meet this machine speed workloads, the winning architecture is fast executions off-chain or on a layer 2, and then settlement plus security anchored to layer 1. Now, in Ethereum's documentation, it says it pretty explicit. Rollups execute transactions off layer 1 and then post data back to the L1 so they inherit the Ethereum security. And Ethereum is scaling by improving data availability because rollups and light clients need strong guarantees that transaction data is accessible. On the roadmap side, Ethereum is scaling rollups via these blob transactions we were talking about before. And the newer upgrades like the peer DSA aim to increase DA capacity by about an order of magnitude for 2s. This is how you get AI throughput without sacrificing financial grade settlement. The last solution, AI assistant governance and dispute mediation for the DAOs. Governance is another place where AI can help, not by replacing humans, but helping by reducing chaos, summarizing proposals, and detecting conflicts, analyzing voting behavior, and flagging risk. For disputes, there are already Web3 native arbitration systems like Claros and the centralized dispute resolution protocol implemented on Ethereum. Think of this like AI can do triage, classify disputes, pull evidence, summarize claims. Then decentralized arbitration systems provide structured human judgment with incentives. That's a path towards scalable governance that doesn't rely on a single corporate moderator. So the regulatory and operational dues is a quick checklist. If you're building in this environment, your compliance posture is part of your product. You have to build disclosure workflows for AI generated content. Regulators are moving fast there. Design provenance, signatures, attestations, timestamping, audit logs. Use L2s for high frequency actions and settlement on L1. Keep humans in the loop for governance and dispute escalation. The goal isn't just more tech, right? The goal isn't just more of anything. The goal is abundance, lower transaction cost, cheaper coordination, and trust at internet scale. When verification is cheap and composable, we can build systems where more people can participate in finance, ownership, identity, and work without needing permission from the gatekeepers. Now, this is the thesis. AI accelerates everything, and Web3 is the trust layer that keeps it from breaking society. What are the key takeaways? 10K to 1 million agents. The first, we talked about the on-chain agents. We're gonna see that increase. We're gonna see it increase to levels that we're not gonna understand. And because of that, that's why we went over the importance of infrastructure and security. We're going to see an increase in the decentralized exchange volume, right? Maybe to 4 trillion. We'll see. Who knows? When will this happen? It doesn't matter. But the thing is, we're starting to see more and more an increase in participation when it comes to the blockchain. Now, the AI and agents today, we went over how that 50 billion was kind of whatever, but it still shows us that there's still a high market cap and we're just at the beginning when it comes to all of this. So it may not be a full 50 billion, but we may be hitting there even though we got there earlier in 2025, but even at a low 30 billion or so right now is still an increase to 20 from 2023, and it's just getting started, right? So as more blueprints come out and more people understand this new technology, those numbers should increase, and we should see an increase in account users and growth as well. Institutional view, right? 67% plus in institutional traders. We're talking about AI and machine learning. The trend is up 53% from the prior year. And banks are publicly crediting AI tools for speed plus client responsiveness during the volatility. Now you may say, whoa, this presentation wasn't what I was thinking. And I'm glad it's not. And I hope you're walking away from this workshop with something to think about and some new information that you may have not have known before. And if that's the case, I've done my job. My name is Simon from W3MCT. I am the founder and CTO, and I'm here to provide a solution, an AI solution to your business.